Danny Blanchflower, a former member of the Bank of England's Policy Setting Committee and now a professor of economics at Dartmouth College in Hanover, New Hampshire, which is where he is this morning. Danny, always great to have you with us. Let's start by talking about the B of E, or the BOE as people like to call it. So no change there. Quantitative easing remains at £175 billion, interest rates at 0.5%.
Right.
Did they do the right thing?
Actually, I don't think they did, but I've been saying for a while that they've got to do more. And actually, Mervyn King and David Miles have been saying that. So the market, everybody expected this to happen, but they have a problem, which is the forecast that they produced 2 months ago, which said they've got to do more. So what we've seen is, if you like, a monetary policy by the back door. Mervyn King talked about essentially the possibility of changing the discount rate, and essentially it's been talking the currency down. So there is need for more, and I think November will be a the big meeting. They'll do another inflation forecast, but I suspect they're going to do some more.
Now, when you speak of more, you're speaking of expanding the quantitative easing program, the bond purchase program.
I'm actually thinking about the discount rate that held on remunerations, on reserves, may well be something that they can cut, but that looks to be a decision that the executive, that Mervyn King, can take. Certainly thinking about more quantitative easing, and I suspect there's still a thought about the possibility that the 0.5% rate may be able to come down further once you sort out the legal restrictions that impact building societies and banks' balance sheets. So I think they really have to do more, especially because the evidence this week has been weak. The industrial output numbers have actually meant that the National Institute has actually changed its forecast of Q4 from a positive back to zero. So that I would think on the net this month the news has been slightly worse than it was a month ago.
Danny, Deirdre here. What are the chances now that we see a W recovery for the global world, or for the global situation, versus a V?
Well, I think I think we've talked about this on several occasions. I think we're trundling along the bottom. I have in my mind a lot 1937, when people suddenly said, "Oh yes, things are absolutely fine," and then you start to change monetary policy and you push the economy back into W. I think we're just trundling along the bottom here, and we're going to see. And I think the Obama administration in the U.S. has actually sort of seen that and understood it. The question is whether other countries in the world have seen that.
Danny, we've talked in the past about the similarities in the challenges facing the UK economy as the US economy, the potential for persistent job losses or at least high unemployment through the end of next year. Given those similarities, how do you reconcile with that the hawkish statements we've been getting from the Fed lately? Warsh, Plosser, Fisher, Lacker, yesterday Thomas Honig, the president of the Federal Reserve Bank of Kansas City, all saying that we need to see interest rates head higher sooner than later.
Well, I mean, people need to say those kinds of things. Presumably there is there's a broad tent, if you like. People have a different set of views, but I think it's very early days to be saying that, and I think you'll see this is only one or two people. This is not a central view. You haven't heard Bernanke or Larry Summers or any of those kinds of folks saying it. I think it's very early days, and in a way I would warn, this may well be dangerous talk. Think about 1937.
But Danny, we were also talking about the potential for the BOE to increase its quantitative easing program, buy more bonds. Obviously, the intent here is to raise asset prices, but many people have been raising concerns about the potential for an asset bubble. What's your view?
Well, I think it's all a little confusing, especially in the UK. I mean, the stated purpose of doing QE, the Bank of England states it on its website. The idea is you raise asset prices, but its chief economist the other day said the worry about quantitative easing is it may rise some asset prices. Well, the question is, which asset prices do you really care about? Obviously, you want to see some rising, but maybe the worry is that asset prices move into a bubble. Maybe you might think that the current jump in the equity markets, you might think of it as a bubble. So there's part of it is a confusion about what it is people think quantitative easing is supposed to do. The idea is to lift people, make them feel better, if you like, more confident that the economy is going to bounce along. So on the one hand, you're trying to do something, but on the other hand, you're trying to prevent a bubble occurring. So, I mean, at the moment, I think we just have to keep easing along. The bubbles are somewhat on the horizon, and then eventually you'll start to worry about an exit strategy.
But didn't you just sort of say that maybe U.S. stocks, for example, maybe corporate credit has begun to get ahead of itself in terms of the pricing, the spreads?
Well, certainly if you're a data person, as I am, if you sit and look at the fundamentals and you say, where's this growth coming? Where's all the positive coming? Where's the job generating coming? Look across all the sectors of the US economy and the British economy and you say, where are the sectors that are generating jobs? And you struggle to find any. So this is, if you like, a hope and a wing and a prayer that down the road things are going to be better, but retail sales aren't doing it, and it's hard for me to actually see this generating of profits places.
And Danny, you've also alluded to the cuts in public spending in the UK as well.
Well, the talk in the UK currently is about cutting spending, and this is all very interesting. The Tories this week had their conference saying they were going to cut spending, but it doesn't look to me like the time to do it. This is, if you like, an economic war, and when you go into war, you have to keep going. You don't say, I can't defend my country because the cost of it's too high. So talk of repaying the debt, if you like, is fine in a boom, but not in the depths of the greatest recession we've seen in our lifetime. So it's all about timing. Clearly, you need to control the debt, but now, I don't really think so. I think the danger, certainly in the UK, is that the Tories' credibility is under question, and they might well end up generating lots of unemployment, not employment.
Danny, we want to ask you about what you called an outlier when you, Eric, and myself were speaking during the break about Australia's move out ahead of the pack, raising rates, sort of a surprise move a month earlier than expected, the only G20 country to do it. What do you make of that? What does that say about the global economy?
Well, I don't think you're saying necessarily much about the global economy from it. I mean, I was at an OECD meeting the other day, all the OECD countries plus a number of others, and the message coming out of that was, this thing certainly isn't over. We're all in this together. One or two countries may be in a slightly different position. Australia may be, more linked to what's happening in China, more linked to commodities. But I don't think you should really take anything from the fact that Australia has moved. The question, in a way, for Australia is, what about the rest of the world? If the rest of the world's demand isn't rising, then we'll see. But I don't think it tells us a great deal about the rest of the world. It's certainly a country that's rather different, and maybe at a different point in the cycle, but I don't think it really tells us much, if anything, about what's happening in the rest of the world.